I'm talking about things that are just universal,
Oh, got it.
that are sometimes wrong,
Oh,
incorrect.
well, that's a
Like
different.
yesterday, I had a buyer put together an LOI, and he made the first 2 years of the seller note interest only, and he told the broker it's because SBA requires that.
Oh,
What they do.
they don't.
So,
Okay. It happens. Well, thank you to everyone that's tuning in from Touchstone Talks. We have Michelle Orr from Live Oak Bank, and she's going to be educating us on SBA lending and how you can use it to make an acquisition, grow your company, what the limitations are.
thanks for having me. I'm excited to be here.
Of course, of course. So, how long have you been lending SBA in general?
It's been about 26 years. I started off in Providence, Rhode Island, working for Textron Business Credit. Wore many different hats while working for Textron. I worked in the closing department, the credit department, and then ultimately moved into a sales role where I've been the last 20 plus years.
Excellent. What made you say, I want to go into banking?
I didn't.
Okay.
Prior to joining the banking world, I was a financial planning counselor at a college. And I happened to see an advertisement in the newspaper for a job with Textron and knew it was a great company. So I entered at an admin level and worked my way up.
Oh, excellent. That's not a typical path, which is always fun to hear.
Yeah, it's not. But I grew to love it, especially in the SBA space of banking, because that's, where entrepreneurs are looking to finance an acquisition or start a business. And I really enjoy helping people do that.
And that's what keeps you here then.
It is.
Excellent.
Absolutely.
Yeah. Business owners are an interesting breed, right? It takes a very strong person to make something from nothing.
It does. Yes, I agree. Very resilient people. I think we saw that play out spectacularly in COVID. People recreating their businesses to accommodate their customers and, living through that time that none of us had experienced.
Yeah.
And so that's why I really enjoy being that critical part of their team, when they're acquiring a business or starting a company or expanding.
Absolutely. So Live Oak's process, in my experience, we've done a couple deals with Live Oak on our smaller deals. Live Oak's process makes SBA feel a lot easier, in my opinion.
Thank you.
Than what do you guys do differently?
I think first and foremost is, we're very intentional about who we're lending money to. We have a pre-qual process where the buyer will submit a certain set of documents to us for review. I do a very in-depth analysis with those documents, and then I bring in a credit manager to review the deal with me and make sure that it's really a deal that we feel strongly about and that we want to do, quite frankly. And that's on the front end, where most banks do that much later in the process. So if I issue a proposal letter to a buyer or, a borrower, it's because we want to do that deal. And once it goes through underwriting, as long as nothing pops up that we didn't know about, it will be approved.
That's a good step. There's nothing like getting all your documents to the bank and then finding out that they're not going to lend on it. So we talk a lot within this show about acquiring businesses. You fill a very big void for that. So if I have a business and I'm sitting here as an owner and I see, there's somebody next door that I want to acquire, but I don't know how to get money for that.
Mm-hmm.
How do I think about that from an SBA perspective?
So I think what you're referring to is an expansion, right? And the SBA program is wonderful for that because you can technically finance 100% of that transaction if it's in the same NAICS code.
Okay.
So if you're a manufacturing company and you're purchasing another manufacturing company in the same NAICS code, you can finance 100% of that transaction. Of course, the cash flow needs to work, right, for 100%. But That's the beauty of the SBA program in general. It's higher leverage and longer amortization, really helps with the cash flow when your payment is stretched out. If you're buying a business, it's 10 years. Real estate's 25. If you're buying a business with real estate, it's a blended term.
Makes sense.
Yep.
Makes
So, expansions are the best way to grow a business, in my opinion, versus starting something from, from scratch. When you buy a business, it comes along with customers, revenue, the name, the brand. So, really a good tool. And I've done a couple of those this year, actually. One was for an HVAC business, buying another HVAC business in Connecticut. And then I had a daycare owner purchase another daycare to expand.
Yeah. Growth through acquisition is something that a lot of our businesses can benefit from.
Absolutely.
So what are my requirements for how much can I borrow? How do I know that?
Sure. So the SBA program caps at $5 million. We're a little unique in that we'll add a conventional loan to that up to $4 million to achieve $9 million in total financing if needed. And that's what separates us from a lot of our competitors. That $5 million is per NAICS code. So if you are an entrepreneur and you've utilized your $5 million in one particular industry, and now you're buying something in a compatible industry but not the same, you do have another $5 million in availability in what we call SBA runway.
Which makes sense. So just to make sure that everybody's following, that would be if you are acquiring something doing the same thing you were doing, and then you acquire something that is an ancillary component, like if it is manufacturing a piece that you use versus.
Yep. As long as it's not the identical NAICS code,
yeah,
you do have that new, fresh $5 million of runway.
That's excellent. Now, can they para pursue that as well? Can they do the other?
Yes.
Okay, so you could do some significant back-to-back acquisitions.
Yes, we could.
That's fun.
We do like to see some time in between there. So growing too fast is not something we're comfortable with. Usually within like a year's time minimum to look at a second acquisition with us if we've just done one.
Integration is not fast. So probably
True.
By the time you get it integrated, you're at your year.
That's very true.
Anyway, just from an operational standpoint.
Yes, you're right.
That's not quick. So let's talk about the first-time buyer.
Mm-hmm.
Because that's also someplace you could use an SBA loan.
Yes.
So if I'm looking at a business and I own nothing now, how do I get a loan?
Sure. So that's the majority of our borrowers are first-time buyers. And we do a lot of diligence around understanding who the buyer is, what their background is. Do they have what it takes to step into the shoes of the seller and operate the business successfully? More so than if we were lending to an established business, right? So, for us, it's a matter of cash flow, experience, and the transition plan. It is a 10% down payment if it's a first-time buyer, and that's an SBA policy, so that will be the same bank to bank. And you can absolutely couple the SBA loan with a para pursue for a first-time buyer, but again, we're going to be focusing a lot on their experience and what they bring to the table.
You've used the word cash flow several times.
Yes.
Tell everybody what you mean by cash flow in terms of lending.
Sure. So, when we look at a business and we have a seller that's exiting, there's going to be automatic add backs in that scenario because, officers' compensation, their health benefits, maybe they're paying for their automobile through the business. So we're basically taking the net book income and adding back anything that's non-recurring to the buyer.
Okay. And is there a certain amount of cash flow it has to have to be able to be approved?
That's going to be different bank to bank. For us, if it's not a preferred industry vertical of ours, we are looking for a 1.5 debt service coverage. If it is a preferred industry vertical, it's lower, it's 1.25. Okay. But that will be different bank to bank.
Okay, excellent. What about your process in terms of we've gotten the terms, we've signed the term sheet. or go.
Mhm.
If I'm coming into this never having done it before, all of a sudden things get really busy for me.
Yes.
Why is that?
And that's when it's critical to work with a bank that has a lot of experience doing these deals because it is a lot. It can be overwhelming, especially for a first-time buyer. So I consider myself the quarterback in the process. And from start to finish, I'm holding the borrower's hand in terms of what they need to accomplish and when. Also, building a team that's reliable and that has equivalent experience to us at the bank.
Mm-hmm.
Um, and so it starts off, with the pre-qual process, like I mentioned, gathering certain documents to do my analysis, issuing that proposal letter. Step 2 is underwriting. So once they accept my proposal, it moves forward to an underwriter who does the full underwrite and submits for approval. That's typically 7 to 10 business days, which is pretty quick.
That's very fast.
And then once the loan is approved and they sign the commitment, it goes to the closing process where they'll get their closing checklist. They'll work with their attorney to gather the items. Seller's counsel gets involved in that as well. And we close within 5 business days from the checklist being complete. I would say from start to finish, the average timeline is 60 days for a non-real estate transaction. However, I have seen it done much quicker when you have a very motivated buyer and seller.
There's a lot of information that the bank needs
Yes.
in order to make sure that all of the financials are correct.
And we do provide the buyer with a checklist during the underwriting process of all the closing documents that are going to be needed to give them a leg up.
Okay.
We encourage them to work on that as soon as we provide it to them. And that's what shrinks that timeline, quite honestly, from 60 to 45 days. People that take that seriously and get it done.
Absolutely. Going on vacation in the middle of your deal.
Not recommended.
Not recommended.
No.
But happens.
It does. There's holidays that, sometimes happen that slow us down. But I can say this with honesty that it's never the bank that slows things down. It's always one of those things, vacations, holidays, an environmental pops up on a real estate transaction. Some things are just out of our control.
Right. Absolutely. So your deals tend to be a little small. How often do you require someone to do a quality of earnings or some type of a financial assessment?
Sure. So it's very rare in our world for a quality of earnings, although I am working on a deal right now where the customer engaged GCF to do a quality of earnings report for him. But that's an $11 million transaction. I would say the norm is $10 million and up for quality of earnings. We don't require it per se, but I have had deals that are larger where the credit manager has asked for it.
Okay. So what do they have to do for the bank in terms of?
We order a third-party valuation, and every bank has to do that. It's an SBA requirement. And so the customer gets a full copy of that report. That usually satisfies what they're looking for. Of course, they have their CPA and attorney as part of their due diligence team. And so,
or they should.
As they should. So they're working on anything else that may not be covered in that report, but it's very comprehensive.
Excellent. That's good news.
Yes.
Helpful. What else should they know?
I think they should just be prepared, in advance to put the time in, get us the documentation when we request it. No one likes a long, drawn out maybe. I take a lot of pride in quick response time when it comes to assessing a deal at the front end, but also getting it through our process. So it's typically me following up for what we need to get it to that next step. And I think that if buyers could be proactive in their approach, especially once they have a signed LOI with the seller, it'll just make things go a lot smoother.
Yeah. We see all the time where they just are like, oh, we're done now. We have a letter of intent. And it's like, no, you're just starting.
Yes.
You're just starting the process.
Absolutely. And being transparent, right? Because we're going to learn things throughout our process. like a Cavers issue or, a past credit history issue. And just being transparent up front makes it a whole lot easier to deal with.
Yeah. As long as you know it up front,
Hmm.
right? There are things that could be unearthed in diligence that then you have to deal with.
Right.
How involved does the bank get to be in the contract between the buyer and the seller?
So I like to I take it a step before that. Actually, I encourage my borrowers to send me the LOI before it's submitted
Okay.
because I have seen things inserted into an LOI that aren't eligible. So, for instance, SBA does not allow earnouts. I can't tell you how many LOIs I've seen with earnouts. So it's important to know, up front before you submit that, and there's a lot of back and forth, what you can and can't do. And so that's, I start at the LOI stage, and then the purchase contract, really it's our attorney that digs through that to make sure there's no eligibility issues.
You don't want to read the 65-page legal document?
I look at it to make sure that the terms that were agreed to in the LOI stayed consistent to the purchase contract. But in terms of legal review, we have an attorney that does that to protect us.
Yeah, I don't blame you. What are some red flags that would make something go awry?
Sure. So from the selling business perspective, red flags are fluctuating revenue trends that are hard to understand, or fluctuating profit margins.
Okay.
Employees, if there's key employees that aren't transitioning with the sale, for instance, or if there's too much of the day-to-day relying upon the seller.
Okay. And those you would find in the pre-qualification
Correct,
process.
because I asked a lot of questions around that. And that's why we ask buyers to do a transition plan, because we want to make sure they understand as well up front, what is this business going to look like once I purchase it and the seller's gone? I mean, there's always going to be a seller consulting period of some sort, but eventually they're going to exit, right?
Right.
And with an SBA loan, they have to exit within 12 months.
That's an important thing to know.
Right.
So
other red flags, if there's customer concentration, we dig into that we do a deep dive on customer concentration. I would say anything more than 30%, we have a hard time getting comfortable with.
Okay.
Because if that customer disappears, of course, there goes the revenue, right? So that's not to say that a business owner can't replace that customer, but it takes time.
Right.
So that's another kind of red flag for us is customer concentration. And then industry type, right? There's certain industries we stay away from. For instance, we're not lending to independent restaurants, although we'll do franchised QSRs.
Okay.
So there's certain industries that bring a level of risk that we're not comfortable with, and every bank has those, right? They are
Makes
different
sense.
bank to bank, but it's something that I let people know right up front. If you're looking for a business in this space, it's not the right deal for us.
That makes sense. So SBA had kind of an update.
Mm-hmm.
What changed this year with the
Sure.
SBA?
Quite a few significant changes. So I guess the first one that comes to mind is citizenship, right? So every owner, no matter how, if it's 1% of the borrowing entity, has to be a U.S. citizen or green card holder.
Okay.
So that's a change. Partial buy-ins have become a lot more complicated, so that if the selling owner is retaining any ownership, but the seller had 20% or more to begin with, then they have to personally guarantee the loan for 2 years, which most sellers don't want any part of that. So partial buy-ins are not as clean unless I have a situation right now where a customer is looking to buy a business and the mother owns most of the business and her sons are the operators and their current ownership is less than 20%. So if that transaction does happen, my buyer can do a partial buy-in and utilize the experienced operators to stay on however long, and they won't have to guarantee the loan.
Okay. That's fortunate that that structure is there.
Yes. So it really takes time to evaluate the current ownership structure and understand what they're trying to accomplish and what that structure looks like post-closing to determine if it's eligible, right?
Makes
It's not
sense.
as clear cut as it used to be.
Okay.
But, that said, you can still get some transactions done, just maybe not as many as partial buy-ins.
Makes sense. Makes sense. Anything else major change?
The equity injection. So if the seller note is going to be counted towards equity injection, it does need to be on full standby now, which it was in the past, but then it changed to
Right.
2 years. Now it's back to full standby. For first-time buyers, 10% is what we're looking for. Although SBA policy does allow that to be split, 5% buyer, 5% seller with the full standby. We prefer that first-time buyers, it's their first time doing this, have the 10% skin in the game.
So if it's on standby, is it on standby until the entire loan is paid?
Yes.
So if I'm buying real estate, that could be 25 years?
We don't interpret it that way.
Okay.
So that's an interesting question, because I think since the new SOP came out, it wasn't confirmed with SBA, but prior to the new SOP, if we had that scenario, we were having it be on standby for 10 years.
Okay.
Until the business piece was finished.
Completed. Okay.
Exactly.
I like that interpretation better. It's not great, but it's better.
I agree.
So if I have it on standby, let's say I really like the person I'm selling the business to,
Mm-hmm.
and so I'm encouraged to help with this 5%. I can't collect interest either, right?
It can accrue, but
It
you
can
can't.
accrue, but I can't collect it.
Correct.
Okay. What if my buyer pays off the loan early?
Then
I can start getting paid?
exactly.
Okay.
It's
So-
only when the SBA loan is still outstanding.
Okay.
Yeah.
Hiccups, right?
Yes. There's lots of things to remember. And the older I get, the more difficult that becomes sometimes. Just kidding.
That's okay. How often are updates done to the SBA? So if I'm a buyer and I met with a bank or a couple of banks when I start looking,
Mm-hmm.
like when do I have to check in again to make sure I have all the right facts?
So there's not a set time that the SOP is updated, quite honestly. When there's a change in administration, you can probably expect some changes, but there's not, an annual SOP update.
Okay. Well, that's good to know too.
Yes.
So hopefully we're done for a little bit.
Yeah. And we're the first ones to know, obviously, if there's going to be changes coming down. So we are very diligent about communicating that early.
Absolutely. Otherwise you can't close the deal.
Yes.
I know we chatted right after you found out about the SOP, and thank goodness we were working on a deal together, and it closed weeks before that came down.
Yeah. And that was a partial buy-in.
Yeah. I was saying it was a partial buy-in, and it would have never closed
No.
with the new standards.
No, because those owners would have had a guarantee for 2 years.
Right. Which they would not have done.
No.
Because like many owners, they had no debt previously, so they had no guarantees on anything.
Right.
So to go into a situation where they would have to guarantee something.
And you just said something that reminds me to say a lot of sellers have owned these companies for numerous years, some 20 plus years.
Oh, most of them. Yeah.
And so it's not uncommon for the business not to have debt, right? And so we're looking at this sometimes putting $5 million of debt on the company, and it's hard for the seller to understand why the buyer's asking so many questions and why they may want a seller note. And so that's important for not only the buyer to be able to explain that in a way that the seller can understand, but also their advisor, right? So in your role, just, having them understand that the balance sheet is changing dramatically with this change of ownership. And so there's going to be questions. There's going to be things that the bank needs, the buyer needs for their
Right.
due diligence. And I feel like if the communication is open and everyone's on the same page, it just goes a lot better.
It's difficult for some sellers to understand. They've always operated on cash that they generated.
Right.
So to go into a situation where now there are set requirements and reporting requirements, because you hear from your buyers on a quarterly basis with
Yes.
financials
Yes.
post-transaction.
We do.
And I think that's fabulous, right? Like,
Yeah.
let's make sure if there's a problem, you know about it in advance.
That's why we do it.
But that's just not how people are necessarily
Accustomed.
accounting for
Yeah.
things in their day-to-day
Yep.
pre-transaction.
It's evident when we receive internal financials that they're not used to keeping those up to date.
Right,
But we get there.
right.
We eventually get there.
Say, as long as everybody is working together to get things corrected, then that's the best way to look at it.
Agree.
Any last SBA thoughts? Any last thing you need to leave our sellers and buyers with?
Yeah, I would just say that, working with the right team, lender, M&A advisor, CPA, attorney, even insurance, insurance is an important step in the process. It's really critical to having a positive experience. So be very thoughtful about who you're bringing onto your team, especially if you're a first-time buyer and haven't been through this before. It's really critical in making it a positive experience.
I agree completely. So, final question. It's asked
Sure.
standard across all
Uh-oh.
all episodes. If you were not doing this, what's your other career choice?
I have a real deep passion for animals, specifically dogs.
Okay.
I think you know that.
Yes,
about
I
me.
do.
So I don't know if I would run a rescue, or I don't think I could be a veterinarian. Probably a rescue
Rescue.
of some sort.
Excellent.
Yeah.
We'll look forward to that.
I appreciate
some
the question.
years down the road.
When I'm retired.
Exactly. Your
Yes.
retirement plan is.
I think that's a good plan.
Excellent. Well, thank you very much for joining us.
Thank you for having me. It's a pleasure.
Oh, well, I apologize. One more question.
Sure.
Timing in terms of when they should call you.
Early. The sooner the better. We do buyer prequals before they even find a business.
Mhm.
And so some people might think that's not worth the paper it's written on, but I do believe there's a purpose for it, right? So
We like to see it.
it really allows me to understand who the buyer is. Are they looking in the right places? We do have some buyers that kind of don't have an industry focus. And then when I understand who they are, what their experience is, I can guide them the right way. So earlier, the better.
Great. Thank you.
You're welcome.
For more episodes, make sure you're liking and following Touchstone Talks. And thank you for joining Michelle and I.
Thank you so much.
You're welcome.